So start the chapter 6 handout on planning, and then also start the monetary unit sampling. And that's about it. So we will go ahead and get started. Sorry. We'll get started on chapter 6, and then we'll go over to monetary unit. Chapter 6 is a little bit dry, so we try to intersperse it with a little bit of sampling stuff. But yeah. So the chapter 3 handout on planning the audit. And basically there are 6 steps to the audit, 6 kind of broad steps, and they kind of overlap sometimes, but you know, these are kind of the steps they do. Planning the audit, obtain understanding of the client and internal controls. These two kind of go together. So even though they're listed separately, they're not always, so, you know, it's not always cut and dry which one you're doing first. For instance, it's hard to plan the audit without having some kind of an understanding of what the client is like, you know, so a lot of times these two are kind of mixed in together. Okay, assess the risks. Perform audit procedures. This is the bulk of the audit. Oops, not bulk. It's not even a word. You know, this is all the testing and getting all the documents you need, getting things signed, contacting people. So this one, even though it looks like it's rather insignificant, this is, you know, probably 80% of your time is here. Complete the audit. There's a few things you got to wrap up at the end of an audit, and then you form an opinion and issue your report. So the audit report comes at the very end, obviously, and it's based on all this stuff up here, mostly number 4. You get enough information that you can make your determination. Okay, I think we talked about this before, that assets are the easiest category of accounts to prove. Did we talk about this already? I thought we did. Maybe we did. Assets are the easiest to prove. So whenever you're kind of planning for an audit, that's the one you go to first. Your assets, you know, we're all sitting in an asset. You know, the computer's an asset. They're the easiest to prove. You go lay your hands on them, a lot of them, anyways. So because they're the easiest to prove, this is usually where we start out. Oops, that's not one. So we start auditing the assets. The next step we go to are the liabilities. Sorry about that. And we can prove those out too. Now notice, these two sides have to equal. So if you prove the assets and you prove the liabilities, by default, excuse me, by default, the equity is going to be proven. And if the equity is proven, then highly likely that the income statement stuff is proven. So when we do an audit, we start with the assets. We really beat up the balance sheet, especially the assets. They're easiest. Now notice that we also, while we're proving out some of the assets, we'll prove out other things too. For instance, cash. I can't remember if I talked about this to you guys already or not, to be honest with you. But for instance, revenues, you know, the ones that are in cash, when we get the cash statement, we get the bank statements and that for the cash, and start going through the cash and prove it out. We're also going to be proving out these revenues that are cash. You say, well, what about ones that aren't cash? What about ones that are on account? Okay, those go to accounts receivable. And then what happens? They go to cash. We collect them. So even though we're auditing cash, which is an asset, we can prove out the revenues, and we can do this with many, many accounts. Hey, we're not coming up. For instance, you use cash to pay off your expenses. So while you're proving out cash, you're going to pay, or if accounts payable, if there are accounts payable. Use cash to pay for your long-term stuff. Inventory, same thing. Buy cash with inventory. You can prove out in cash. You can prove out some of your inventory stuff too. In inventory, again, you can go count that too. Also, so we can really get a lot of things proven just by going through. Well, first of all, just the cash account, but other accounts too will prove out the revenues. For instance, inventory is connected to revenue. When you sell inventory, it's a revenue. So we really beat up the balance sheet when we do audits, and especially the assets, because they're the easiest. Question on that? Okay, next thing we're going to be talking about are the risks. The risks involved, whenever you do an audit, you look at the risks. What are the risks? What are the things that could go wrong? And some of them you have control over, and some of them you don't. And obviously, those ones you have control over are your own audit, basically. So let's go ahead and take a look and see what these kind of look like. Inherent risk. We're going to make these. I'm going to separate these a little bit. Oops. Now, is the risk that a material misstatement will occur? And this is for the client. I'm going to add one more thing before I go on. Risk, if you think about risk, you always want risk to be low. Okay, so when we're talking about this, so the risk that a material misstatement will occur, you're hoping that's low. It could be someone enters a $6 stapler for $6 million. Right? You hope that that's a low occurrence. So whenever we talk about risk, lower is better. Okay, so this is the risk that a material misstatement will occur. Control risk. The risk of the client's internal controls will not identify Okay. And again, this is the client also. Oops. Probably better term would be will fail to. I'm not sure. Either way. Okay, so the first two are the material misstatement occurs. Now, if it does occur, someone puts in a stapler for $6 million, hopefully something's going to catch that. Either the system will have a limit on it saying, no, there's nothing in this company that goes in for $6 million, kicks it out. Or if, at least it'll hit somebody's budget and someone will be in the office saying, wait a minute, how come my budget's over by $6 million? And, and they trace it back to the stapler. So hopefully the client's internal controls, that you'd like that risk to be very low, that they wouldn't be able to catch that error. Okay, detection risk. So list the auditors will fail. So if the client fails on finding it, so this is the auditors. Now notice something. This detection risk, this is the only thing that the auditors have control over. So if the company fails to identify a material misstatement, it occurs and they fail to identify it. The last hope is the auditors. Okay. Now, the auditors, they will assess the first two, the inherent risk and the control risk. They have no control over those, though. I mean, they'll assess it. They'll come up with number, what they think it is, whether it's 1%, 2%, 10%, whatever. But they honestly have no control over it. And notice that this is historical, also that this happened in the past. So even if they do correct the internal control weakness, if they correct it, it still was there during the year. You can't jump in the time machine, go back and correct it from January 1st. So if they find it and correct it in, say, October, there's still the chance that anything up until October, there could be problems with. So keep this in mind that we're simply assessing it. We can't change it. I mean, if we could change it, we'd go back and turn them all into zeros, but we can't do that. So we are simply assessing the risk. This is so inherent risk is only assessed by the auditors. We can't change it. If we could, we wouldn't have to do an audit. And control risk is only assessed by the auditors. This one, the auditors control. Control is a better, but maybe not a good word. Well, I don't want to get that control mixed up with this control up here. So auditors have power over the detection risk. They do not have, they can't change these. Even if they wanted to, they can't change it. And audit risk, is risk that an undetected material misstatement will come on the financial statements. And hold it now. I don't say occur, I should say appear. The risk that an undetected material misstatement will appear on the financial statements. Now, if we detect it and we alter our audit report, that's fine. Well, it's not really fine, but you know what I mean. It's those ones that we don't know about, where we issue they issue the financial statements and we think they're okay when they're really not. Save a little space here. Okay. There's actually a mathematical formula for this. I'm positive that it has appeared on the CPA exam twice. I don't know if it's appeared more than that, but the kind of formula is inherent risk times control risk times detection risk equals the audit risk. So for example, this down here, we had 40, 50, and 20. Now these are kind of high numbers, but you know, the idea is what we're looking at here. Control risk was 50. And detection risk was 0.20. Oops. Go whatever that equals. Oops, turn the calculator on first. That's a tip. Okay, so these are because of 0.04. So this would mean that there'd be a 4% risk of material misstatement showing up on the financial statements. Any question on that? Now, here's the thing that, like I say, I'm not sure how many CPA firms actually go through that. However, looking at that kind of model, there should be a big realization that if a company, if you believe that if there is a fraud going on, notice that the inherent risk and the control risk go to 100%. In other words, they're not going to catch it. They're going to be intentionally misstated. And then the only thing that's left to catch it are the auditors. So, I mean, ideally, it's just like we just showed you, you know, that if someone makes a mistake, hopefully it'll be caught by the controls. Mistakes happen. But the danger of fraud is that the inherent risk and control risk both go to 100%. The only thing that's left are the auditors to catch it. So that's why fraud is really, that's why they really focus on fraud so much. In general, if financial statements are really misstated, oftentimes it is fraud. For just the reason I told you, if you put in a $6 million stapler, somebody's going to notice it. It's going to hit somebody's budget. Somebody's budget's going to come in and they're going to say, what is this $6 million charge? You know, it's going to usually, so a lot of times when there is a misstatement, especially larger companies, a lot of times it is a fraud because you don't usually have huge errors that go completely unnoticed. The material misstatements that go completely unnoticed in the company. Okay. All right. Give me 1 second here. What am I doing here? Okay. Okay, client acceptance. One of the things that's strange about, well, a few things are strange about auditing, but one of the things that's strange about auditing is that you don't just give your services to anyone. That, you know, you really cannot be, it's a very bad thing to be identified with people who are of ill repute. You don't just take anyone for, it's just not like McDonald's. McDonald's, anyone goes in, they order a hamburger, you don't care what their background is or anything, they get a hamburger and they walk out. It's not like that for CPA firms. You pick and choose who your clients are. And it's not like that for many professions. Lawyers, for example, are under some onus to take clients that, you know, even though they may not be such savory people, they might take them anyways as clients. Doctors, they have a Hippocratic oath. If someone comes in, you know, they are bound to do what they can to help that person. So there's all these other professions that are different than us that we pick and choose who we do. And another thing that's weird about us is that, unlike other professions, independence is big. You know, if you're a doctor and your daughter is sick, you can go ahead and help your daughter. I mean, there's absolutely nothing wrong with that, and be encouraged. It's a good thing. As auditors, it's completely different. If your daughter has a company, a business, and you think, oh, okay, well, you know, she needs an audit, you can't do the audit. So it is kind of a strange, you know, there's a couple of things going on there. There's independence, but there's also not getting mixed up with people who would damage the reputation of the CPA firm or their clients. Okay, first thing is the CPA firm qualified? If the auditors believe Okay. So if the auditors believe they can complete the audit effectively, they may accept the new client, even if they have no expertise in the client's business. And if you think about it, if they don't have a client in that business, for instance, let's say that the new client is a flower shop, a big flower shop operation or whatever. They may not have ever done flower shops before. But if they feel like they can get knowledgeable enough, flowers and, the time constraints and how they get flowers in and the process and all that kind of stuff. If they feel like they can get comfortable enough to do the audit, they can take it. And you think about it, it would be kind of weird to get the expertise to do audits that you don't actually have. There'd be no reason to learn how to audit flower shops if you don't have flower shops for a client. So until you get a flower shop for a client, you're probably not going to learn how to audit flower shops because it may never happen. And it's the same way with a bank or an insurance company or a trucking firm or whatever it is. If you believe you can get the information and you can get the information from where you need, you could hire somebody to come in, and someone who's more familiar with doing audits of flower shops to come in and help you. There's nothing wrong with doing that. But you have to be able to think, to honestly believe that you can compete it competently. Now, if you don't think you can, or if it's iffy, then you can't take it. So, it is possible you say, well, look, I've never done anything like that. I don't know. There's flowers have to get in, they have to get sold in a certain period of time, and you have these suppliers that work and how they come from all over the world and all this kind of stuff. We don't do that. If you don't think you can do it, then you can't take it. Okay. And second, can the audit be completed? So if the client doesn't have the appropriate evidence available, then you can't complete the audit. If somebody, they have a business and say they do the entire business in cash and they don't keep any records of anything. It's just all cash. Cash goes in, cash goes out, they buy whatever it is, at a market or whatever, and they pay cash for it. They don't have any receipts for it. They don't have any control over the cash. There's nothing to audit. You can't do an audit. So it is probably, I heard of other ones where like a famous person, a famous person will own a company or something, and you say, well, I need to talk to this person. They'll say, oh, no, you can't talk to them because they're famous and they can't, you can't do the audit. If you can't talk to the owner of the business, you can't do the audit. You don't know what, and two, it's a scope limitation. You're wondering, well, what is this person going to say that I don't know? So anyway, if you don't think if you don't believe that you can complete the audit, then you must turn it down. Legal and ethical requirements. I think we already talked about this. Independence, we beat that all up. Other clients, lawsuits. I'm gonna skip that one. We've already done that. It's in this chapter. Obviously, if you have if you're not independent, and by the way, usually the way CPA firms will say we have these clients, and you come into that CPA firm, they'll say, do you have any of these stock? Does anyone in your family have this stock? Blah blah blah. If they do, sell it. That sort of thing. It's usually kind of a quality control thing that they have to make sure that people that they don't run into the problem with not being independent. you may ask the question, what happens if you start doing the audit and you have somebody on the audit that you find out is not independent? You have somebody on the audit who maybe owns shares of stock in the client, or maybe some of their brother is the chief financial officer or something like that. What do? At that point, you have to issue a disclaimer. You can't give an opinion. Somebody else has to come in and do the audit. So if it does come out that you're not independent, you issue a disclaimer and somebody else has to come in and do the audit, which is obviously not good for anybody. Okay. There are two basic times you get a new client. The new client can either be somebody who has already had auditors and you're coming in as the new auditor. So they had these other auditors, and for whatever reason, could be good or bad, they're switching auditors. Maybe that auditor is retiring. That auditor left the country, went to jail. That auditor is a jerk and they don't like him. Whatever it is, they had an auditor before, and now you're coming in as the new auditor. There's also the possibility that you're auditing somebody who's never been audited before. There's no previous auditor because this will be their first audit ever. So you have these kind of two different things. So the first one we're going to concentrate on is if there was a previous auditor. And that's usually the more, as far as auditing is concerned, that's the easier one to do. Okay, the successor auditor is the new auditor. The predecessor is the, you guessed it, old auditor. So successor is the new auditor. That's the auditor coming in. The predecessor is the old one.
Could you scroll up to number 2, please?
Mm-hmm.
Thank you.
I didn't put anything in number 2.
Oh, okay. Sorry. Yeah, I just looked up after listening. Thank you.
This is basically the chapter 3 stuff that we covered. Oops. That you gotta be independent, and it could be lawsuits, it could be other clients suing each other, and or even competing if they're depending on what they are. They may prohibit you from taking the new client on. Okay, integrity and reputation of the client. This is, if you look at the CPA, all the stuff that they have in the CPA, the integrity of the client is the biggest thing. The biggest thing is the integrity of the client. Actually, I'll say the two biggest things: the integrity of the client, and that you must be able to complete the audit. Those are the two big things. You can't take an audit that you don't think you can complete. Period. The integrity of the client is the next biggest thing. If you think about it, on some level, you have to trust the client because, not that. Because of this up here, on some level, you have to trust the client. So if you can't, then you should not take them on as a client. Now, you are required, if they have a previous auditor, you're required to contact the previous auditor before you accept them as a client. Now, you can't just call them up out of the blue and say, hey, give us the dirt on this company. What happens is you talk to the client, you tell the client, look, you have to give them a release so that they can give the information freely to us, and then we'll contact the predecessor, the old auditor, and talk to them about it. So you have to get permission from the client. it has to be done before you accept it. And now, suppose that things were bad between the client and their old auditor. They say, look, I don't want you contacting those people. You know, they're a bunch of jerks. And, you know, if I got to pay you more because you have to do more work, that's fine. But I don't want you talking to them. You guys are idiots. You know, can you take it? Nope. And you tell them, you know, look, you may very well be right. They might be complete jerks and, you know, idiots, but you know, we still have to contact them. We still have to contact them before we can accept the audit. And you know, they have to approve you contacting them so that they can get a release so that the predecessor auditor can contact them. Now, the successor auditor is required to contact the predecessor, not the other way around. The old auditor has no responsibility to contact the new auditors. It's up to the new auditor to contact the old auditor. So you can't say, well, they never contacted us. It's not their job to contact you. Okay. Predecessor auditor, if one exists. Okay, well, the one thing that there is out there for publicly traded companies, so this is for issuers. They have a thing called an 8K report. Now, the 8K report is not just for changing auditors. It's whenever a change is made in the company. So if you get a new director of design, there'll be an 8K. The new director of the 8K will go in and will say, so-and-so is no longer the director of design. Blah, blah, blah is the new director of design. And that's basically it. You file that with the SEC. So the SEC knows who's going and who's coming in. But it could be for a number of things. You know, 8K could be for, they do it for mergers, buying up a competitor, buying up something else. So then an 8K that says, okay, we have bought blah, blah, blah. 8Ks are simply there to let the SEC know what your company is doing. All right, and so, you know, it's for significant things. It's not like, you know, came out with a new flavor of ice cream or something like that. It has to be something significant in the structure or in the people running the company. Okay, so I actually sent out a sample of the 8K. And this is it. It's a fairly stark document. It's just basically the facts. And this one a while ago, 2014. So this is, they approved to get Deloitte & Touche to do their audit, and they dismissed PricewaterhouseCoopers. Okay. In the 8K, they have to specify if there was any substantial disagreements with the auditors for the last 3 years. So in that 8K report, they will send it to the SEC. And if there were any significant disagreements with the auditors, they would have to put those disagreements in the 8K. What happens with that then? The SEC sends it to the previous auditors, the predecessor. It says, is this everything? And it's a yes or no question. They either say, yes, it is everything, or they say, no, it's not. If they say, no, it's not, well, they say, yes, it's okay. If they say, no, it's not, then the SEC comes back and says to the company, the client, look, you're not telling us everything. The auditors say there's more. tell us everything. And, you know, so it goes back and forth until the auditors say, yes, that this is everything. So it goes back 3 years. If there's any major disagreements, it'll be in there. If there's not, you'll see this paragraph the way it is. There were no disagreements between them. The company furnished Pricewaterhouse with the stating whether it agrees to the statements here made here within blah, blah, blah. Now, there's a few things that are not in here. You don't have to say why you changed auditors. You know, the SEC doesn't care. Well, I don't know if they don't care. They're not, it's not like they got bad attitudes, but you don't have to tell them why. You don't have to tell them the dollar amounts that you pay to them or their fees or anything like that. Nothing. Just say we're changing from this auditor to this auditor, just so they know who is involved with it. Now, yeah, so it really is just saying that we changed from one auditor. And by the way, this was very common when the Sarbanes-Oxley rules came out, because you couldn't do the audit and do consulting. So you may have somebody doing an audit for $3.5 million and they'd have 28 million in consulting. Well, it don't take an Einstein to tell which one of those you give up. You give up the auditing. So a lot of times, you know, this is, well, it might seem like it's bad, like, oh, they're, you know, the other auditors are probably mad about it. Sometimes they're not. Okay. Okay. So this is, but anyway, so this is an 8K, you know, not a huge document. This basically says who came in, who left. Sure. Okay. So one of the things you're going to talk to them about, these are some of the reasons why you're going to talk to them. The big thing is integrity of management. This is very important. You know, this is the AICPA will tell you that's probably the biggest thing. Reason for change, whatever they understand the reason to be. Any disagreements with management, communications, related party transactions, anything unusual. Now, you don't ask them about specifics of the audit. In other words, what audit steps did they do for this? What audit steps did they do for that? You don't ask them any of those things. You're going to do your own audit. But you'll tell, you know, but the big things. What's the integrity of management? What are they, you know, what is it like working with the audit committee? Did you have any disagreements with management? What's their integrity? Are they honest? Do they lie to you? What goes on with the management of the place? Okay. So you're going to contact the predecessor, if one exists. Other third parties, bankers, lawyers, and customers. So people who are involved with the client, but are outside the client. Background searches. Some of these can be quite extensive.
So, sorry to interrupt. You're essentially building a character profile for the client.
That's exactly it. And they do have services that'll do a lot of that. I've actually seen some of them are pretty kind of voyeuristic. They really go deep into, you wouldn't believe the amount of information that's out there. But yeah, you're basically looking at a profile of whether you can trust these people or not. And that's exactly what you're doing. And one of the things that they always look out for is that they're shopping for accounting principles. And shopping for accounting principles is when there's a disputed, do I have it in here? Let me write it off. I don't. Oh, okay, disputed accounting principle. Yeah, it's when usually there's been a problem with the audit in that there's a dispute with the auditors. They say, no, you can't count that as revenue. What do you mean I can't count that as revenue? Well, you know what? You're not the only CPA firm in the world. We'll find somebody. And they start calling around. They say, oh, by the way, we account for this way. And how would you would you agree that should be counted as revenue? So they start calling around, trying to find somebody who will agree with their disputed accounting principle. So shopping for accounting principle is when there's a disagreement between the auditors and the client is trying to find another set of auditors who say, look, I'll give you this business if you agree that we can count this as revenue or whatever the dispute is. Okay. One of the things you also have to look at, and this is with any client, is if it's a revolving, an audit going on, is that do you want to continue with them after you've already done an audit? Every year there should be a discussion about whether you want to keep them as a client. If you had a lot of problems with them, if there's some other issues that came up or whatever, you may or may not want to keep them as a client. So on top of bringing in a new client, there's also the discussion of should we keep the old one. Okay. All right. Let's do these. Sorry. Okay, attempt to communicate between the successor and predecessor auditor should be initiated by
The successor auditor.
successor. Attempt to communicate should be made I already said it before. By the way, if the attempt, I say it is possible that you can't contact the previous auditor. Maybe they disappeared. They don't know where they went. Maybe they died. There's reasons why you can't always contact them, but if you can, you should try to. You should always, if you can, you're required to contact them. What will they likely inquire about? A, yes or no?
Yes.
Yep.
Yes.
B,
No.
C,
Yes.
D,
Yes.
yep. E, yep. And now E, just to let you guys know that governance is kind of what they usually call these. Whenever they talk about governance, they're talking about board of directors, audit committee. You may see that in a CPA question. F.
No.
Nope. G. Yep, that's the most important one. Eight K report has which of the following? A, yes, we know that one. B.
Yes.
Nope.
No.
Nope. You don't have to tell them why. 8K is a very brief report. It's a, it's a very stark report. It's just telling you what. So B is not there. How about C?
No.
D?
Yes. D.
Nope, it's gonna be E. 3 years.
Oh, yes.
How about F? F is actually yes. This is so if there's major disagreements, they want to know about it. And again, the predecessor auditor has to agree to it. that those are everything in there. Okay, E, which of the following is the most important consideration? I said, hold on, let me try reading again. Which of the following considerations is important when obtaining a new clients? A?
Yes.
Yep.
F. Oh, are all of these going to be multiple? Then
Yeah, they can be. Yeah. B.
No.
Nope. C is an unusual one. I'll take that one. That's a yes, actually. And the question is why? Because it's possible that they're going bankrupt. And you say, well, what does that have to do with anything? It increases the risk for a couple of reasons. A company going bankrupt can have they can make their financial statements correct. There's nothing, nothing inherent about going bankrupt that means that their financial statements can't be correctly misstated, but it does make things a lot more complicated. There's built-in there's a sort of built-in additional pressure for them to want to look better, to want to increase, their income and all that kind of stuff. So there is more than say a successful company. A successful company, they have less of a need to say cook the books. Also, company goes bankrupt. Who do people sue? They can't sue the company. The company's bankrupt. It doesn't do any good to sue them. The only people that are left with money are the CPA firm. So the CPA firm a lot of times will get hit with lawsuits if a company goes bankrupt. Whether they're successful or not, it depends on what how well the auditors documented what they did and all that kind of stuff. But it does increase the risk a little bit more when a company's going bankrupt. There's also one other thing that occurs when a company's going bankrupt, and that is that oftentimes you'll have to go to a different type of accounting. For example, suppose that this company is doing bad, they're in bankruptcy or whatever, and they say, okay, well, we're going to sell off this division. We're going to try to sell off this division to somebody and whatever. All of a sudden, you're not accounting for that division the normal way. Does it make sense that this division they're trying to sell off that they're going to try to get rid of in the next 3 months? Does it make sense to depreciate everything over the next 20 years? It's not going to be there in the next 20 years. It's not going to be there for 1 year. So you kind of go into a different kind of accounting when it comes to companies going back. So there are some reasons why that are you may, especially a company that's going bankrupt, that may be important. Okay, D, marital status.
No.
Nope. Pending litigation.
Yes.
Yep. Independence of the auditor to the client.
Yes.
Yep. And auditor's competence in the client's industry.
Yes.
Yeah, it is. Now, if you feel like that you can get competent in their industry, you can still take it. But you do have to obtain that competence in the client's industry, or feel that you can, obtain that competence to complete the audit before you can take it. All right, let's stop here. Okay. And the next thing we're going to do is we'll go on break and then we'll come back. But we'll start in on the monetary unit sampling. So you'd be back at 7:10, say. I'll go back to this other page just to make sure everybody has them. Wow, look how small that is. Okay. Ah, okay. Okay, so tonight we're going to start in on monetary unit sampling. And monetary unit sampling is specific to auditing. Classical sampling, you can use that for almost anything. But monetary unit sampling is specific to auditing, and it has some real advantages in certain situations that make it very attractive. The big one is that if there's not too many errors, you don't expect there to be too many errors in the sample, that you can get a much smaller sample size and get and have the same level of confidence. And the testing really is what drives up the price of an audit. The testing is a big number. So if you can get, up to the 95% level, taking a sample size of 80 items instead of 210, it's a huge savings. And it's not the savings for you, it's savings for the client and everything else. So it can be a very efficient type of sampling. It's not used in all situations. We'll talk about that as it goes on. But it's one of those, it's a type of auditing that is specific to, any type of sampling that's specific to auditing. So you won't see this in an auditing class, I'll put it that way. Okay. So overview of monetary unit sampling. So we have these items. So here's the book value items. The cumulative total is, as you go on, you add these things up. So the cumulative total is going to be those two. You go to the next one, it'll be three. Just keep going down to get down here. So the total value of this is 5,000, and it just keeps building up in this cumulative total thing that we're going to have here in the middle. Okay. Monetary use sampling. We're going to have a sample size of 5 items will be selected. Okay, so this is how many items we're going to have are 5. So here's what it does. It says, okay, here's what we're gonna do. There's $5,000 worth in this thing. We're gonna break it up into 5 equal chunks. We have 5 items, and we're gonna pick one item from each they call it interval, or we're gonna talk about but each of those chunks, we're gonna break it into each of those chunks, and we're gonna pick one item from each one, and that one item is gonna represent that entire $1,000. So it's sort of like this. The book value is 5,000 divided by 5 items. Equals $1,000. So each of these will be broken up into kind of like $1,000 chunks. These are called intervals. And from each one of these, we're going to take one item. One item from each one of these. And say that that represents the entire interval. So we're going to total of 5 of them, 5 items, but one from each interval. Okay. Let me get rid of this stuff. So we're going to look for the item using this cumulative total. This differently. We're going to look for the items that cross the first $1,000. So which item crosses the first $1,000? The cumulative.
Item 2.
Close. Which one goes
Oh,
over?
wow. Hello. 3.
Okay. So this one is going to be the first one that we're going to pick. Oh, I'm sorry, find the sample interval, that was 1,000. I should. Okay, so the first one we're going to pick is item number 3. Now we're going to try to find the item that crosses the second one. So at $2,000, which one crosses the $2,000 mark? So on this cumulative total, which one goes over 2,000?
The number 6.
Yep. Which one goes over 3,000?
7.
7. Oops. Again. And 4,000. 9. 10. Okay, so now we have our sample. So we have item 3. Maybe what column was behind this? No, I'll get rid of this. So items 3, 6, 7, 9, 10. So these will be the items that we will pick, and these are the first $1,000 chunk will be item number 3. The next one will be item number 6. So we're just taking one item and saying, okay, that one item is going to represent that entire interval. Okay, so coming down here, let's take first one was item 3. Okay, so we audit over the book. Okay, so let's take a look. So the first, this one, the item, so the book value, excuse me, the audit value was 600 and the book value was 600. So this is just 600 over 600. Which is just 1. Ooh, the spacing here very well. Times the interval. To the 1,000. And this will equal our projected value, which in this case is just 1,000. And the projected misstatement is 0. Man, did I goof this up? Okay, now, and so this one you would, is kind of what you'd expect, right? Everything is okay. The audit and the book amount are in agreement, so that's fine. I'm gonna teach you guys how to be lazy. So, important skill. So going to item 6. Item 6, the book value is 560. Scratch that. The audit value is 560. The book value is 800. So this is 560. We should color code coordinate these better. Okay, now this one does not come out to 1,000. So 560 divided by 800. Seven times 1,000 was 700. So what this is sort of like, it's sort of like the ratio. We did the classical sampling with the ratio estimation. It's kind of like that. So you're just taking one item and doing the ratio estimation for that interval using one item. So one item is the ratio for that interval, and that's what we're going to get a projected value. And then if it's different, then we're going to have a misstatement. I think this next one, okay. Next one is 7. So we had 450 and this is 450. So they're both 450, so we are okay. Number 9. At 300 and 750. So 300 and 750. Okay. Whatever that is. 400. So that interval, only 400 of it is good. The rest of it, the 600 is a misstatement. And 10, these are both 900. Okay. We're going to focus on the total misstatements. We could do it for this one too. Total projected value. $4,100. And the projected misstatement is 900. Any question or anything? So that's kind of the basic idea behind it. We're going to do one more thing tonight on it, but I want you to notice one of the a couple of really great things about it, and why it's a good one for auditing in some situations. Wait a minute, I don't want to do that. I want to do this. We always pick the one that crosses the higher interval, the interval when it goes across the higher interval. So usually that's a larger item that we're more interested in. But it's even better than that. And I keep clicking on the wrong thing. I'm sorry. What do I have to do again? It's even better than that, because notice that if the item gets big enough, if the item is over $1,000, it's 100% certain that it's going to get picked. So if management, the more they cook the books, if they are cooking the books, if they're making things look larger, the more that they cook the books, the more likely it is it's going to be caught. And at some point, it's going to be 100% sure that it'll get caught. Because if they cook the books, up over $1,000, and for any given account, it's 100% certain that account is going to get picked. Even if they spread it out over a lot of accounts, well, if you get enough accounts, it's going to be more likely that those are going to be the ones that crosses the interval. So the more that management increases the value of an account, any given in the sample, the more likely it is it'll be picked. I gotta sneeze. Maybe not. Okay. I had a squirrel get in my basement. I'm in my basement. I had a squirrel get in my basement. I was working on stuff down here, and I hear some scratching. I look around, and sometimes we have birds come down our chimney in here, and they just kind of fall out to the bottom. So I open up the door and expect a bird to come flying out. It happens like once every 4 years or something. Nothing comes out. Like, oh, okay. So I just go keep working. And I went in the back of where we have our washing machine, and there was a squirrel sitting on the washing machine. Just sitting there, loitering. Okay. So anyway, so this is a good method because the more management increases it, the more likely it's going to get caught. And at some point, it'll be 100% sure it's going to get caught. Now, there are times when this method isn't good, as you can imagine. And that is things that management tries to make smaller, things like expenses, things like accounts payable. If they're purposely trying to make things small, it won't get caught. So this is not the method to use. And if they make it small enough, they go down to 0. Well, there's no chance of it being picked. So it's only good for when management is overstating, not for understatements. Okay. All right, let's go to the second page. Now, on this first page, I gave you the sample of 5. On the second page, we get into how do we pick that sample? How do we know how many items to pick? And there's a formula for that. Okay. So here is the sample size calculations. And it's a formula. It's not the easiest formula, but it's still easier than classical sampling. Okay, so what we're going to do is kind of plug the numbers in here. Excuse me, population book value is 1.6 million. So that's this number. The tolerable misstatement is 1.2 million. No, it's not. 120,000. I was lying. And the expected misstatement is 5,000. Okay, so this is, now we have to grab 2 things that are not so easy. Reliability factor and expansion factors. Okay. Now at 5%, excuse me, we had to pick those two factors, and they're at the bottom of the page in this weird looking thing here. So we're gonna have the reliability factor at 0 overstatements. So come down here, reliability factors. Zero overstatements at 5%. Be 3. And we need an expansion factor. Expansion factors are easy because there's only one row. And so for that 5%, it's 1.6. And now it's kind of crunching the numbers. And I think I'll do the bottom first. Okay, so I don't have a spot for it. Came up with 42.86. I'm in a bad cell here. I'll do it over here. Okay, so the sample size is 42.86. Now we can't take 0.86 of an item. So we'll round it up to 43 items. By the way, this method, you round it off to the nearest whole number. I would tell you to round it, always round it up, just in practice. Because if you don't want to go into court saying you round it down, you know, for one item, it's probably worth it not to have that discussion. So I would say, you know, in this case, we're going to round it up anyways, but I would say always round it up. Oops, so we'll say make that 43. All right. Total book value. That divided by 43. And this one we can 1,600,000 divided by 43. 37,209. You probably leave it there if you want. If you could also put the cents in there. So that would be the interval. So you pick 43 items and you go every 39,209. And the second one would be whatever it is. 74, 418.60 or something.
How did you get the 43 items?
When you do this out here, it should come out to 42.86. Did you get this or no?
Multiplying the
Yes. Let me do it here. Let's see here. Yeah, so the top part would have came out to 4,800,000. Oops. And the bottom. 120 minus 5,000 times 1.6 comes out to be 8,000. So 120 minus 8,000 is that.
Okay, I see what I did there. I multiplied the 120,000 by the, was it 8 million?
Oh, okay.
Yeah, I multiplied instead of subtracted.
Yeah, it's weird. And by the way, this is one of those weird things too, that it's an important part of this, the expected misstatement. If the expected misstatement is big enough, you shouldn't use this method. This method is usually used for those things that they don't have very many errors. You'll notice that the bigger that misstatement gets, because it's subtracted, that the numbers can get very large if that expected misstatement is big. Classical sampling, if you expect the misstatement to be off or whatever, it's not that you can still do it. You can still use it. It's not that much of a problem. And notice that if you get the expected misstatement is off more than the tolerable misstatement, it's going to be infinity, right? So, this expected misstatement is very important. Oftentimes this is 0 or a very low number when you use this method. If the expected misstatement is high, this is not a good method to use. Let's do one more. I think there's one more here, isn't there? It's up a little. Now be careful here because this is the 10%. Okay, and again, I came out with 113.24. The real method is you take 113. I'm going to put 114 in. Just again, the whole reason why you're doing this is so if you get dragged into court, you don't have to, back up for it. And so I would just say that round it up to 114. The true method is 113, and if you use that, that's fine. That's actually the way it's supposed to be. So then we have 2,500,000. I'm gonna say 114. If you use 113, it'll be a little bit larger number. If you use 113, it would be close, same. Okay, so I'm gonna say 114. And again, the true method would say 113. I use 114 just because be a little more conservative, I guess, with yeah, well, you just want to have to explain in court that you rounded down. They'll say, why'd you round down? It was part of the method. Why'd you round up? Taking one more item is worth not having that conversation. Okay. And again, this expected miss statement, a lot of times this will be zero. It's when you don't expect any errors in it. But if there are expected ones, it should be small. And again, if these got big enough, if this got up to 40,000, this will go to zero, this goes to infinity. So it really is for, this method really is for when you don't expect to have a lot of errors. This method is very efficient. If you expect to have a lot of errors or a lot of dollar amount errors, it's not very good. But again, it is good if you are if you don't think there's going to be big errors, but you suspect that management might be trying to cook the books, because the more they try to cook the books, the more likely it is to get caught. And you saw here, if they cook the books on any given item to 22,000 or 23,000 or whatever, it's 100% sure it's going to get caught. And even if they spread it out over a number of accounts, so I know we'll just add a few $100s to each additional account. Well, that makes those accounts more likely to cross that interval. So the more likely they're caught, anytime that they would try to overstate an account, it makes that account more likely to be picked. So, for overstatements, this is a really good method. And again, the more they cook the books, the more likely it is to get caught. Any question on that? Okay. Well, let's stop there. Nothing to turn in this week. We're not done with this, and we're not done with the with the chapter 6 one. So we'll take a break on it. I don't think there's another sample size one. No, this gets kind of wacky down here. We'll do that next week. Okay. Any questions?
Nope.
Okay, well, have a good week, and I will see you guys next Tuesday.
Thanks,
Have a
Professor.
good night. Thank you.
Bye-bye.
Night.